Hello everyone, welcome to episode 57. So today we're going to be talking about the crash of two banks, Silvergate Bank and Silicon Valley Bank. So I made the Tamil version in the weekend and there's been a couple of developments which I'll be covering today, and also thanks to everyone who's been watching from the Tamil version to the English version for all the feedback, all the positive feedback, and how a lot of people have said that they've understood the whole issue with the video that I made in Tamil. So in today's video in the English version, we'll be talking about the same content but also a couple of other developments and how this crash compares to the 2008 financial crisis, the impact on economy and impact to crypto in general. So as usual, disclaimer, I'm not a financial advisor or investment expert. All of my videos are just to share my personal understanding and my personal experiences. I never ever send your money to people who call themselves as professional brokers, because most of them are frauds. I keep repeating this because that's one of the common mistakes people make in crypto and investing, by sending their money to somebody else who's calling themselves as a professional broker. So I'm very active in Twitter at Chennai to London, and even if I'm not posting content, I'm posting some of these warnings, some of these updates in Twitter. And if not me, Twitter is a great place to follow all of the information with regards to crypto and get a quick update from a financial perspective. So Twitter is open and public, and so it's a bit safer than the other alternatives. A couple of updates before we jump into the actual content. I posted about Render in my end of December 2022 episode, and also in January. Render was about 40 cents at that point, and it jumped up to almost $1.48 in the end of January within about 3 or 4 weeks. And I did mention at that point that I am realizing some of the profits because the markets can turn at any point in time. So when it went from 40 cents to $1.48, almost 250% jump, I did talk about realizing some of the profit, and without realizing the profit, just maintaining the position is not a good practice in terms of investment decision. And there needs to be a balance between greed, like holding for a better profit and more profit and not selling anything, and a sensible decision in terms of how much you can sell, because there will always be a market crash or a black swan event. So I keep mentioning about the fact that realizing profits is one of the most difficult things to do, and also when you realize those profit, holding it in USDC, USDT or BUSD, spreading and maintaining them in these stable coins is important for days like this as well. So it's an extremely hard thing to do, but these days, where it has actually fallen down from, it touched almost $2 Render, and then it fallen down to almost like below $1 today. And these are days where this makes even more sense. And I did not sell at the top. I didn't know that it was going to reach $2. I did sell. I started realizing profits at $1.5, but still it was good enough profits for me to take out and maintain my liquidity for days like this when it falls down below the point where I'm selling. So nobody can predict what the top or the bottom is, but it's a good practice to always try and keep yourself mindful of the fact that in crypto, volatility is always going to happen, and there's always a crypto crash that is going to happen because of external factors or black swan events. Even if it doesn't, it's always a good practice that once you've realized that liquidity, you can invest it in another project, even if this doesn't come down at the point where you have sold it, right? So just an example where Bitcoin had fallen from nearly $25,000 to below $20,000 in a span of 1 week, and Render again dropped from nearly $2 to less than $1, one of my top assets which I had talked about in my previous videos. So let's talk about the black swan. First of all, what is a black swan event? I kept mentioning black swan event. It's an unpredictable event which is beyond what is normally expected. So like in a normal course of circumstances, this is an event that you do not expect, and that's what is an unexpected or an unpredictable event, is a black swan event. And this always has a negative impact on the markets, and specifically crypto market, because where there's a lot of volatility as compared to some of the other financial markets. Now, in the last year, in 2022, we saw probably the most number of black swan events, starting from the Luna and USD crash to the FDIC crash, from where Sam Bankman-Fried had committed major crimes, and the related bankruptcies of crypto firms like Celsius, 3AC, Voyager, etc. So we had probably the most highest number of black swan events in 2022. And 2023 had been a literally better year till this point, or till this week, I would say. So the three major events where the crypto friendly bank, which is called a Silvergate bank, which is termed by the news agency a crypto friendly bank or crypto bank, had collapsed. And a couple of days later, another big bank, Silicon Valley Bank, SVB Bank had collapsed on Friday. So these were two major bank collapses, or comparatively, impacting the crypto market really badly. And also the budget of the US government, where the capital gains tax was significantly increased in the US government budget, which also negatively impacted the crypto in a way, I would say. But the banks are the main stories of the day today, and today we're going to be talking mainly about these two banks. Right, so if you had opened your news on Wednesday this week, and you would have seen almost every news article calling it as a blow to the crypto industry or a crypto winter, or calling Silvergate Bank as practically a crypto bank or a crypto friendly bank. So the impact to crypto started on Wednesday, but it was not a major impact to crypto as much as what was to come from the Silicon Valley Bank fall. So why was Silvergate Bank called as a crypto bank? Because it started as a small community bank for a few years, and then around 2016-2017 they started a more crypto friendly approach, where many of the banks weren't being too much crypto friendly. Silvergate Bank started having tie-ups and partnership crypto exchanges to hold their funds for them. So major exchanges like Coinbase, Binance, FTX, all of them had funds with them in terms of deposits, loans, and even Circle, for that matter, which issues the stable coin of USDC, had also used Silvergate Bank for their asset collateral and maintaining the USDC in Silvergate Bank. So from a technical perspective, Silvergate's fall was a pure bank run, and that's because investors and depositors were pulling out funds at an accelerated rate, which will cause any bank to fail. And we talked about this bank run even in one of the previous episodes. Typically, the bank does not hold all the money that the customers or public are depositing into the bank, because they have to make money out of it, and they will probably give them as loans to the public. At any point of time, if entire depositors try and withdraw their funds, it's going to collapse the bank, because the funds are not there with the bank at any point of time. That's a liquidity crisis, and that creates, it's basically a loop. The more people start withdrawing and the more the bank is panicking, the cycle will continue to grow, and this loop will eventually end in what is called as a bank run. So what caused it for Silvergate Bank is probably, I would take it back as further as 2021, when Silvergate Bank decided to side up more with FTX instead of Binance. In terms of my story about FTX, where I had compared between what Binance was doing and what FTX was doing, and how much of a criminal the FTX founder Sam Bankman-Fried was, and how he was misappropriating customer funds and using it for his own company, Alameda Research, and he was literally gambling away people's money. Silvergate Bank had ties with both Binance and FTX at that point of time, and it cut ties with Binance, which was probably doing everything by the book at that point of time and hadn't put a step wrong. And yet, instead of cutting ties with somebody like FTX, they actually cut ties with Binance and started siding up more and more with Sam Bankman-Fried and FTX. And when the FTX criminal conspiracies were exposed and FTX had exploded, Silvergate shares started tumbling down, and there was almost nearly an $8 billion bank run that happened for Silvergate Bank when the FTX collapsed, because Silvergate Bank had a lot of money that was funds and interaction with FTX at that point of time. They were seen as the major banker for FTX at that point of time. Right, so the general perspective from several analysts was that Silvergate Bank, being the primary bank that FTX and Alameda Capital were keeping their funds with, they could have easily spotted the discrepancies where money was being moved from FTX to Alameda, and yet they did not do anything about it, or they chose to not do anything about it. Although Silvergate Bank had denied all of this, and they said that they've done all the due diligence, the basic due diligence that a bank should do, and they never saw any of this coming, which is really hard to digest, because a bank would have probably known to a certain extent what was happening between FTX and Alameda, and an early action from a bank like Silvergate could have saved a lot of funds for people who lost their funds with FTX. Now, the domino effect had started in December 2022, like I said, $8 billion being withdrawn. But I think what added to the pile, or what added to the domino, was the Bloomberg article in January, where there was an article about Department of Justice investigating Silvergate in the FTX scandal. I think it was on the 2nd or 3rd of January. And that forced Silvergate to cut nearly 40% of the stock because there was a mini collapse of their share price and they lost nearly 50% on their share price on one day. And ever since that point, Silvergate was practically on the edge of collapse, and it was predicted or it was expected that they're going to collapse at any point in time. So it didn't come as a huge surprise to a lot of people from the perspective of the collapse of Silvergate Bank, because it was expected to happen. It was all it needed was just a final trigger, and that final trigger happened last week when Coinbase announced that they're pulling out all their funds from Silvergate Bank because of all the issues that I've seen on the 2nd of March. And once Coinbase announced it, pretty much all the major exchanges, Paxos, Bitstomp, Galaxy, all of the major exchanges which had partnership with Silvergate Bank started scaling back and started publishing publicly that they've pulled out all their funds from Silvergate Bank. So it started pretty much on the 2nd itself, the final fall of Silvergate Bank. And on 8th of March, they announced that given everything that has been happening, they voluntarily announced that they're going to start shutting down the bank and they're going to start a voluntary closure of the bank. And the good thing about it was that there were no major crypto exchanges that got impacted because most of them had already cut ties with Silvergate Bank and taken their deposits out. And also there was quite a number of warnings, and it resulted in a voluntary liquidation, which meant that the wind down of the bank operations is not one that follows with the usual chaos, and was going to be more of an organized administration where they're going to wind it down, and they also assured the full repayment of all deposits was the plan for the bank. So there wasn't a lot of panic, even though the newspapers and the news articles had said that it's going to be a major impact to crypto. This didn't cause as much flutter as was expected from the news articles or the headlines, which called it as the crypto winter or the crypto bank that has collapsed. But in an extreme coincidence, within a couple of days on Friday, so 8th of March, Silvergate Bank collapsed, and 10th of March, another bank, Silicon Valley Bank, had collapsed. And this was a much bigger concern for the financial markets around the world. And the biggest reason being the size of the bank. So SVB, Silicon Valley Bank, was the 16th largest bank in the United States with assets valued $200 billion plus. And compared to Silvergate, which had probably about $10 to $15 billion maximum value of assets, it was literally 20 times bigger than the Silvergate Bank. And also, it was the second largest collapse in the United States in terms of the asset value. So if you look at the size of Silicon Valley Bank at the point when it collapsed, they were 16th in the United States. They were ranked in terms of 16th. Although, if you look at the top four, they had trillions of dollars worth of assets. If you look at the 5th largest bank, even that's nearly Silicon Valley Bank was nearly like half the size of the 5th, even though sitting at 16. So you can see that the top 20 companies in the amount of assets that they have, how significant the Silicon Valley Bank. And it was only the second largest bank to fail, only next to Washington Mutual, which had collapsed in 2008 during the subprime crisis. And the comparison between what happened in 2008 to the recent times tells another very important story, which is during the 2008 economic crisis, the greed of the banks and the subprime crisis, which snowballed, caused a major chaos and caused a lot of banks to collapse at that point of time because the regulations were not stringent enough. And if you've never understood what subprime crisis was, then probably we can talk about it another day. But it's basically about bad mortgages being sold, where overvalued mortgages were being sold without any due diligence. That's precisely what subprime crisis was. But that was basically because all the banks were greedy and most of the banks had done no due diligence at all when providing loans to their customers, which is not the scenario today. But the comparison between what happened during 2008 and what is happening now is that nearly 465 banks in the 3 or 4 years that followed after the recession of 2008, nearly 465 banks had collapsed in the United States alone. In comparison, if you look at what happened in the last 5 years between 2018 to 2022, and or even till last week, till March 2023, only 8 banks had collapsed or 8 banks had failed, and the biggest of these banks had about 150 million in assets, and the rest of the banks were like 30-40 millions in assets. So comparatively, if you take the Silicon Valley Bank collapse in March 2023, which nearly $200 billion in asset, the last 5-6 years, you can see that comparatively nothing like this had ever happened, and that is why it was hugely concerning that nobody had expected a bank like Silicon Valley Bank to collapse, and it came all of a sudden, and it came in the middle of a period where people thought that everything had stabilized, nothing like this is going to happen, nothing like the 2008 crisis is going to happen again. So what actually caused the bank run of Silicon Valley Bank? I had shared a few Twitter threads in my Twitter feed, which talks about in detail technically what happened, but a lot of this was too technically detailed that it was not that easy to understand. So I created a simplified version to make it a bit easier to understand. So compare this, right? So imagine the federal rate. So all of the bank home loans and the deposit interests are all tracked to a concept called as a federal rate, or like, in UK, for example, it's the base rate by Bank of England. So it's very similar to what happened in RBI, where there is an interest rate that is being set and the banks will follow with a tracker interest on top of it. So the federal rate in 2021-2022 was about 1%, let's assume, right? So an ABC bank, a bank like ABC Bank, is taking customer deposits and giving them 0.5% interest on that deposit, and is able to put a markup on top of the federal rate and giving out home loans to people at a 10-year fixed rate of 1.5%. Now, at this point in time, it is giving loans at 1.5%, and it's only giving deposit interest at 0.5%, which means it's making a net profit of 1%, like net interest income, what it's called NII, and it's in profit at this point. Everything is hunky-dory. But in 2023, because of the inflation, because of the cost of living going up, and the federal government trying to control the cost of living, they are increasing the interest rate at this point in time. And this is one of the common tools used by the government to try and fight inflation. So the rate goes up from 1% to 5%, let's assume. Now, all of these home loans are fixed at 1.5% for 10 years, so they cannot increase, the ABC Bank cannot increase the home loan percentage. But now the customers and investors, they are seeing another bank, XYZ Bank, which hasn't tied their money into these home loans, and they're able to offer 3% interest because the federal government is offering 5%. Now, typically the customers and investors would want to withdraw their money and deposit it at a higher rate with another bank where they're getting a lucrative deposit interest. And this is called, this is typically called as interest rate shopping for bank customers, for large investors. Now, the bank has two choices. Either they have to live with a negative interest rate of minus 1.5% by giving 3% interest to the bank, to the depositors, to keep the depositors, and live with a negative interest income, or they will have to try and somehow get the money to avoid the bank run, so they have to give the money back to the withdrawals, support the withdrawals for the customers, investors, which they did not expect, and they don't have this money because most of their liquidity is now logged into this 10-year fixed loan. That is what happened in this case. And if you think that there was a bit of exaggeration in the story, actually the reality was even bigger. So I talked about 2021 to 2023, but within a span of 1 year, in March 2022, the interest rate, the federal government interest rate, was 0.25%, and today it's at 4.75%. It increased much more rapidly in the last 12 months, which the federal government had hiked the interest rate continuously, and it went from 0.25% to 4.75%, not even from 1%, but 0.25% to 4.75%. So, and UK is no different. UK went from 0.25% to nearly 4% beginning of this year, and that too in a quick rapid succession. So interest rates had been increased by the government, and what SVB had done different to the example that we just gave was that there's a couple of differences, a few comparisons that we can make, is that not all of SVB's income was coming from this concept. Only 73% of SVB's profits come from this net interest income. They also have 27% other sources of investments and revenues. And even this, out of this 73%, it's divided into two groups, where one group is mainly for startup investments. A lot of startup companies get loans from a Silicon Valley bank, because it is a Silicon Valley bank. It is from a Californian bank, so where startups are quite common. And the rest of it was coming from MBS, or mortgage-backed securities. Not a direct home loan, but it's basically a security that is backed by a home loan or a mortgage-backed security, that it's commonly called as. And these mortgage-backed securities were having an annualized yield of 1.56% with a 10-year lock period. And in 2021, when the post-COVID, there was a small boom that was happening. They saw a surge of deposits from customers, and with the government giving the incentives to the citizens, and also the small boom that happened. They saw a small surge from $62 billion to nearly about $190 billion. And they didn't know what to do with this money. And in a moment of bad decision making, they chose to put majority of this money into this 10-year locked MBS, or mortgage-backed securities, which is probably one of the worst mistakes that they had done. And this is also because there was a large part of money that they had suddenly acquired, and they didn't know how to properly invest it at that point. And when their NII started getting negative on 8th of March, when they were experiencing a liquidity crunch, on Wednesday, they sold their available for sale portfolio, one of their major portfolios worth about $21 billion, at a $1.8 billion loss. Now, in normal scenarios, they would have waited and they could have got the full $21 billion. There was no necessity for them to sell it at a crunch. And that sale at a $1.8 billion loss explained to the market that there was a liquidity crunch, and they were selling their asset at a loss to cover the liquidity crisis. And this was the first time that the markets found out that there was a liquidity crisis going on in Silicon Valley Bank. And this snowballed into the catastrophic failure that happened in the next couple of days. And again, we talked about the fact that it's the second largest collapse of a bank. But if you look at the number of banks that had collapsed in terms of the size, Washington Mutual was obviously with $300 billion was the biggest bank to collapse in 2008 during the subprime crisis and the economic recession. But comparatively, even then, the bank that collapsed after Washington Mutual was IndyMac with $32 billion, and even prior to that, it was only about $40 billion. So there hasn't been a bigger collapse like this. If you leave out the 2008, even with the comparison to 2008. So how did we end up with the second largest collapse in history, when there were only 8 banks that had collapsed, and there were so many safety measures and stringent regulations that were put in place, and all the learnings that we had from 2008. So one of the big reasons, the fact that we had only 8 bank failures in the last few years after 2008 failure, from 2018 to 2023, is because the stringent regulations that were put in place restricted the banks from making stupid decisions or doing something without due diligence. And this meant that they were supposed to have reserves for the moments of crisis like this specifically. But in 2018, President Donald J. Trump signed a bill that lessened the scrutiny for what they called as the regional bank. So Silicon Valley Bank, as a result of being operating in certain regions, it was termed under a regional bank, and the chief executive of Silicon Valley Bank, Greg Becker, was a strong supporter of this move. And this reduced scrutiny on the banks meant that they operated as a regional bank, and it allowed them to escape the scrutiny and the regulations that had prevented such collapses in the last decade, and which is what had led them to making an investment decision with billions and billions of dollars at that point of time, which could have been prevented if that bill was not signed or if that regulations were not reduced for the regional banks. Now let's talk about the impact to crypto and the impact to USDC, because the impact of the collapse of Silicon Valley Bank was much bigger to crypto than the other bank that had, Silvergate Bank, that had collapsed on Wednesday, so in a span of 2 days. And typically the biggest impact was because of the FUD, fear, uncertainty and doubt on USDC, the attack on USDC. So USDC is a stable coin that I had explained in one of my videos, that It's issued by a company called Circle, and it had fallen down after the Silicon Valley Bank collapse from $1 to $0.9. And typically the collateral backed stable coins are not expected to fall from $1. And even if it does, it's supposed to be a small 1% deviation. But nearly a 10% fall on a stable coin caused chaos, and it turned crazier to, from crazy to crazier every moment that passed on, because people were writing stories without having a full understanding of what was actually happening. So I wrote a Twitter thread where immediately on that day when the issues were happening, I wrote a Twitter thread calming people down or explaining what was happening. And if you do not know what a stablecoin is, in episode 20 I made an English version as well. I explained what a stablecoin is in USDC, USDT, BUSD. Most of these stablecoins I had explained the role of stablecoins in crypto. I'll give you the link to that video as well if you want to watch it. And USDC is a stablecoin, a very popular stablecoin that was issued by it's maintained by an organization called Circle, and it's kind of affiliated to Coinbase in general, right? So, but it is one of the highly governed or audited stable coins, and every month there is an audited report that is published on the Circle website with regards to the reserves of USDC and how much reserves is being maintained against how much USDC is being minted, and these reports are publicly available. So if you go and see the and it's audited and shared in circle.com/transparency. If you go and see it, about $43.5 billion on circulation when I was making this video 2 or 3 days back, and $11.1 billion are in cash reserves across the 6 banks, and $32.5 billion are in short-term treasury bonds. The short-term treasury bonds are of no problem as such, they are issued by the government. But out of this $11.1 billion, they are maintained across 6 banks as per what Circle had published. $3.3 billion is maintained or is in SVB, Silicon Valley Bank. So if you look at it, that's nearly 8% of the total USDC reserves of Circle that is sitting in Silicon Valley Bank, and the rest of the 92% of the reserves are liquid, and you can see it in the audit as well. But when people talked about it, they were talking as if all of the reserves of USDC were stuck with Silicon Valley Bank. That is how the story was being made up. Nobody explained the fact that only a small portion of USDC was sitting in Silicon Valley Bank, and even that wasn't lost. It wasn't clear to people what was happening. So what actually happened on Friday was that there is an organization, a government, an independent government agency called as FDIC, Federal Deposit Insurance Corporation, which was formed back in 1933 to protect such scenarios where a bank collapses. And FDIC offers a deposit insurance up to $250,000 for every customer when such an issue happens. They step in, like in UK, for example, FDA offers up to £80,000. In US, the FDIC offers up to $250,000, where they step in and they take control of the bank. So they become a receiver of the failed bank. All of the bank's assets, all of the debts, they come in control of the FDIC. So the bank is no longer allowed to take any decision making. They take full control of the bank when such risk arises. So on 10th of March 2023, on Friday morning, FDIC shut down SVB and took full control, which meant that they can no longer operate in the way that they want, and FDIC had taken full control of it, which meant there was more positive news for the depositors that they might get more of their deposits back. And so Silicon Valley Bank will definitely have a deficit in terms of the dollar value of their assets in terms of today's values versus their liabilities. But if you actually look at their asset value on paper, it will be similar to their liabilities, because unlike 2008, where subprime mortgages were being issued on paper against a $1 million mortgage to a house that only cost $250,000, most of these assets are real assets with yield bearing assets. The only fact is that they are not current, they are logged in and they're not currently redeemable. So any healthy financial institution can actually buy these assets at a small discount, which is good for both the parties, where SVB gets their liquidity and the financial institution gets an asset at a smaller discount. So they're able to buy like a $20 billion asset at a $19 billion price, which is a $1 billion discount, which is yield bearing for the next 10 years. And these bigger banks like Morgan Stanley or JP Morgan, they don't have a financial liquidity crisis, and they can they can afford to buy these things, which is a win-win from their perspective, right? So in fact, after I had written this and made this video today morning, on Monday morning, the UK entity of SVB has been bought over by HSBC. So that was a clear example of why a bigger bank or a healthier financial institution will actually buy the assets of SVB. So like I said, unlike 2008, this is a clearly different scenario where the mortgage-backed securities that SVB has are properly collateralized financial instruments and will be bought or should be bought by a bigger bank or a bigger institution. So the only major issue that we're talking about is the liquidity crunch at this point in time. And FDIC has already come out with an action plan and a full FAQs. If you actually went to the website on Friday, they had already said that on 13th March, when the banks open, the insured deposits up to $250,000 will be immediately available to most of the depositors. And even for the uninsured amount, the remaining amount, there's going to be future dividend payments. They're going to be dated payments available, and they will come up with the plan of action, how they're going to sell off the assets of Silicon Valley Bank so that they can support the rest of the payment. So, but there will certainly be a small portion of amount that FDIC will not be able to recover from SVB in order to pay the all the customer deposits. But the general expectation is that 85 to 90% of the customer deposits can be returned because of the fact that FDIC has stepped in and because of the position that SVB is in right now. So for a larger organization like Circle and pretty much many of the multi-billion-dollar firms, this 10 to 15% is very small against their net annual income and can be easily adjusted against the net annual income that these companies make, like Circle, for example. But the primary impact that we would have is on many of the startups. They are in their early years, and a 10 to 15% loss for a startup having only $1 million or $2 million in their account is probably going to be really difficult for them to manage, because they need to pay their employees and they need to continue their operations, and surviving a haircut on their deposits like this is probably going to be really difficult. So it is something to observe how FDIC is supporting small startups compared to the larger organizations, and there could be a wider impact on the industry in general, which is already recovering from COVID at this point. So and what this will do to the other banks who could have a similar decisions or similar exposure, because SVB may not be the only bank that made a stupid decision like this. There might be some smaller banks that might have done something similar. So how they are able to recover from this kind of news and this kind of exposure is something that we need to wait and watch. And again, final thoughts on USDC. From my perspective, it's one of the most stable audited coins, and I've already mentioned in episode 20 that it's one of the stable coins that I trust, along with BUSD and USDT. If I have to rank them in order, USDC, BUSD, and then I probably put USDT as a third option. But a lot of people are moving their funds to USDT from USDC and selling their USDC as a loss, which is ironic, because USDT has never even clearly published their reserves. And a lot of crypto savvy investors at that point started an arbitrage process of buying more USDC, and even I did the same. I announced it on Twitter as well. I converted some of my BUSD or USDT into USDC because I was getting more, and I clearly knew it was only a matter of days that it was going to go back to $1. So the FUD and panic that people create, and people who do not understand the details, just reading the headlines that USD reserves are completely lost, that is what people try and make use of. So never ever, it's not a financial advice, but always do your own research and make sure that you understand something before you take a decision. Because personally, when I made this video, at that point it was sitting at 90 cents when I started making this video, and by the time I even finished the content on Friday or Saturday, it was already back up to 93 cents. And today it's at $1. Whatever I had said on the weekend, we are at Monday evening today, and it's already back to $1. So again, just make sure that you understand all the facts before you take a rational decision. If you had sold your USDC at less than $1 during this panic, then that means you need to reevaluate your position in crypto and reevaluate your whole investing strategy in crypto, because you cannot be susceptible to panic, or you cannot be susceptible to a FED like this. You need to understand the details, make sure you follow the right people, make sure you get the right facts before you take your decisions. Again, it took a lot of time for me to make this content, so I thank the people who put an extraordinary amount of comments in the positive comments and positive feedback in the Tamil video. And again, if you could just take a minute to post your feedback, I think it'll be really appreciated. Thank you, and until next time, bye.